Um, so, in addition to including the squared value of the residual, the previous residual, you can just include a lagged value of the entire equation as well. So we had an equation for sigma squared of t that was equal to alpha naught plus alpha 1 times u of t minus 1 squared. And what we've done now is basically added in another term here, which is just a lagged version of what's on the left-hand side here, okay, as well. And that's a Garch 1-1 model. Tim Bollerslev came up with that in 1986. I think he got the Nobel Prize for some of this work that he did. And it's not that complicated, really, the model. I mean, you could have come up with this. You know, you could have, when you're running your own regressions and you could easily come up with trying lag versions of these things. I guess what's a little bit innovative is that it applies to the variance of the residuals rather than the actual the variable you're trying to explain. But this is a Garch 1-1 model, and there's been research done. You know, there's a well-known journal article, and the title of it is "Does Anything Beat a Garch 1-1 Model?" And they find that a Garch 1-1 model, in an awful lot of different scenarios for different financial data sets, was the best model. It's quite difficult to beat it. So it's quite a simple model. You've just got a couple of lag terms, and it's quite a strong volatility model. And we covered ARMA models before. And the variance equation, or the Garch equation, is a bit like an ARMA model for variance. So there's an autoregressive. This is the autoregressive bit, because what's on the left here is lagged, and it's on the right. It's included on the right. So that's autoregressive. And there's an NA bit. We saw before that the NA was using lagged versions of the shock in the linear regression, and in this case, it's basically the shock squared, a lagged version of the shock squared, u of t minus 1 squared. So Garch models are very much like ARMA models, and we're going to do both in the lab today. You're going to fit ARMA models in eViews, and you're going to fit Garch models as well. Okay, so we saw how you got from an Arch 1 to an Arch 2 model. You just added in an extra lag residual squared. You can do the same thing with a Garch model. Okay, you can basically add in extra lagged versions of both. So the lagged residual squared, you can have 1 lag, 2 lags, 3 lags, as many lags as you like. And the lagged variance squared term, you can have as many lags of that as you like. Okay. So the first one is the Q, when you see Garch PQ, and the second one is the P. And this summation here, it's just a shorthand notation. Instead of writing them all out, you know, you could write out alpha 0 plus alpha 1 times u of t minus 1 squared plus alpha 2 times ut minus 2 squared plus alpha 3 times ut minus 3 squared. Or you could just write this summation from I is equal to 1 to 3 alpha I times u of t minus 1 squared. So it's just a shorter way of writing the same thing. Okay? You could have, it's a shorthand. So if you're asked in your exam question, there's previous exam questions have come up, and they ask you to give the formula for a Garch model, a Garch 1-2 or a Garch 3-4 or whatever, and you have to write out the equation for that model. You can use this shorthand if you like, okay? Or you can write out the individual lag terms if you like as well, okay? Does everybody understand that, what the shorthand, how it works, what the summation term is? So, let's say somebody asks you, what is a Garch 2-3? you're asked to give the equation for a GARCH 2, 3. This is P and this is Q. So P is 2 and Q is 3. So you have the summation sigma T squared is equal to alpha 0 plus the summation of alpha I times U of T minus I squared from I equals 1 to 3. Okay? So you just substitute the 3 for the Q there. And that's the same as saying alpha 0 plus U of T minus 1 squared alpha 1 plus alpha 2 times U of T minus 2 squared plus alpha 3 times U of T minus 3 squared. So they're the same. This bit here is just a shorthand for writing this. Okay, so if I was asked the question in an exam, I'd write this one because it's easier, okay? And also, you're not going to make an error. If you have to write these out, maybe you're in a rush and you'll put the wrong number here or something. This one avoids that. Okay. So it's handier. Okay, so it's the same with the P. In the P term, we've got 2, so you would go from J as 1 to 2. And you could also write that out longhand or use this shorthand notation. Okay, so really, people get put off by equations. They get confused or put off. But if you understand that the variance, it just depends on itself, lagged, and it just depends on the squared residual lagged. And the number of lags is given by the P and the Q. And you almost always have an intercept term in all of these econometric models. Okay, so we covered that and why that's a good idea. So it should be easy enough to remember these equations. Okay, so the reason that they're there and to examine them is that it's very hard to ask somebody what a GARCH model is or what an ARCH model is without them actually writing the equation. You know, it's very hard to understand, do you know what it is, if you can't write the equations. And that's why it's examinable. Okay. So why is GARCH better than ARCH? So I mentioned that a GARCH 1.1 is normally sufficient to capture volatility clustering. GARCH is more parsimonious, so you need less ARCH terms when you include the GARCH terms. Okay? And it's less likely to breach non-negativity constraints. We saw that the variance has to be positive. It's not guaranteed not to breach them, but it's less likely than an ARCH model. Okay, so I'm just going to skip this bit about unconditional variance. You can calculate, these are conditional variance models, and they depend on what the previous variance was, but you can work out what the unconditional variance is of U of T. And once you have the model for a GARCH 1.1, that's how you get it. It's alpha 0 over 1 minus alpha 1 plus beta. Okay, so the model, the estimation of the model, it's no longer in a linear form, and we can't use ordinary least squares to estimate the model. So we use maximum likelihood. So I covered the concept of maximum likelihood earlier in the previous lecture, and you're basically fitting the parameters of the GARCH model to make the observed returns in your sample most likely. Okay, so you pick the model that makes the observed returns the most likely. So given the actual data, you can try a lot of different parameters for your model. So the alpha 0 or the beta value, the alpha 1 value, and you pick the one that makes the data that you've got in your data sample appear the most likely, given your model. Okay, and actually, the likelihood of you observing all of your data points, given your sample, and given the variance that's an output from your GARCH model, is given by this equation. You don't have to know this equation, okay? It's just for your information. So you know, there's no magic involved. This is basically a log likelihood function, and if you wanted to fit a Garch model or an Arch model, you know, in a piece of software like eViews, it's using a numerical optimizer, and it's trying to optimize the score given by this equation. Okay, and it's varying the parameters alpha and beta to get this score as high as possible. So when you change the alpha and you change the beta, you're going to get different values of this L. Okay, and it's going to try and maximize the value of L by changing alpha 0, alpha 1, beta, and the phi value here. This is just an example for this particular model. Okay. So in this case, it's an autoregressive AOR1 model. So if this was the S&P 500 returns, they depend on an intercept and a lagged version of themselves and an error term. And then we've got a model for that, the variance of that error term. And it's given by alpha 0 plus alpha 1 times u of t minus 1 squared plus beta times u of t minus 1 squared. That's a Garch 1 model. So given these two equations, we can select the values of phi, alpha 0, alpha 1, and beta. And whenever we pick those values, we get a different likelihood score. Okay? And the numerical optimizer will change them and pick the ones that maximize that, and that gives you your model. Okay. So that's the end of that Garch and Arch. Does anyone have any questions on basic Arch and Garch models? Yeah.
For the Arch ones, what could you add? I mean, you could include something like 10 legs, and you can only use the legs that are significant. What prevents you from doing this? Because you said it's difficult to find the number for P. Or why is it difficult? Because
so what happens is that's the Q value actually. Yeah. But that's you get overfitting. Okay. So what happens is the more parameters you give a model, the more likely one of them is to become significant by chance. And it will make some random combination of, it might pick the first, the third, the 7th, and the 13th line are significant. And there's no theoretical reason. It looks like it's just randomly picking signals and numbers and data feeding. And if you don't let it pick so many, it's harder to fit. And when you include the Garch term, it reduces the number of Arch terms. So you see the autoregressive, when you include something, you know, it's like when you include something, y of t is equal to alpha plus y of t minus 1. This includes, you know, alpha plus y of t minus 2, and y of t minus 2 includes alpha. So you're embedding a lot of lags when you include an autoregressive model like that, and that's getting rid of the number of Arch ones that you need. It makes it more parsimonious because you're allowing it to be autoregressive in itself. So in theory, you could capture, with less parameters, you could capture more of the variance when you add in this autoregressive bit, which is what the Garch model adds in.
But this happens dangerous because you're like including all the legs.
Yeah, in one go. Yeah. But you've only got one parameter, so it can only play around with this. It can't overfit. If you included them all separately, you'd have an alpha 1 plus alpha 2 plus alpha 3. And it will start playing around with these values, the optimizer, to make, to get a better fit. And that's overfitting. So that's what they mean by a more parsimonious model. If you can have one parameter that replaces 3 or 5 or 6 parameters, then you've only got one, the chances of overfitting are much reduced. Okay, so we're not going to go into too much more on the Arch and Garch modeling. So once you know the basic models, like I said before, you need to know why we need Arch and Garch models. So what I said about the fact that there's time varying volatility, there's clustered volatility or pooled volatility, the kurtosis that I mentioned, the fat tails and financial returns, and then the leverage effect. So there's some extensions to the basic Arch model. And normally what I do is, in the assignment, you should check as many of these as you can. So when I ask you to find the best GARCH model in the assignment, I want you to check all the P and Qs. So you want to try GARCH 1.1, GARCH 1.2, etc., etc., etc. And then when you find the best GARCH model, use the same parameters, but switch over to one of the other types of GARCH model to see does it improve things. So we're going to cover those next now in these slides. Okay, so we covered the problems that you could actually get a negative volatility forecast from some of these models. And you can't get negative volatility, it doesn't make sense. Okay? And the models that we saw, they don't account for leverage effects. So I said at the start that if you get a negative return, it increases volatility, but if you get a positive return, it might not have as big an effect on volatility. So there's models that take that into account. We're going to cover those. So one of them is called the exponential GARCH, or E-GARCH, and that gets rid of the negativity problem. Okay, so it basically works. It works in the exponential domain. Okay, so you can't get a negative value. So if you take the exponential of everything in an equation, and then you take the log of that, you can't have a negative log value. So that's how they build in non-negativity into the model. Okay, so here's the variance equation. You've taken the log of sigma squared t and the log of sigma squared of t minus 1. Everything in this is constrained to be positive. So you basically end up, when you take the exponential of this, you end up with a non-negative number. If you take the exponential of both sides of this, you can see you get back to just sigma squared on the left, and a load of terms on the right. One of them is basically beta times sigma of t minus 1 squared. But the thing to note is that you've basically just taken a log of both sides of the equations, and when you reverse that and get the exponent, it's constrained not to be negative by construction. Okay? So it's basically a trick to keep everything positive. So you can try this E-GARCH model in eViews. I've never really found it to be the best model, but you know, I'm sure there are data sets out there where this might turn out to be the best model. Okay. So the next one is the GJOR model, and it's named after 3 authors who came up with it. And you can see the first bit of it is just a normal GARCH 1.1 model. Sigma squared of t is alpha 0 plus alpha 1 times the lagged squared residual plus beta times the lagged sigma squared of t, which is sigma squared of t minus 1. And then they've added in an extra term here. Okay, and it's basically similar to this first term. It depends on the lag squared residual, but it's multiplied by an indicator function. So indicator functions are used a lot in econometrics. So what happens is that indicator function is either 0 or it's 1. And if you multiply anything by 0, it's like removing it from the model. It's not there. So in this case, this is saying if the previous residual, when we plotted out our residuals, if the previous one was negative, then that indicator function is going to be plus 1 at this point in time. Okay, so it's going to add in for the variance forecast or calculation for the following residual. It's going to add in an extra bit of variance there, and it's going to depend on basically the size of this. Okay, the size of this previous u of t minus 1. The bigger this is, the more variance it's going to cause straight after it. Okay, so it's going to have a bigger shock, or it's going to have a bigger impact on the volatility in the market. So if you get a very large negative return one day, it's going to switch the variance to be higher the following day. Okay. Okay. So, does everybody understand that? Does that make sense? You can see how if you get a large negative return in the market, you would expect more volatility in the market the next day, and how this model captures that. So, if u of t minus 1 was positive, that I of t minus 1 would be 0, and that extra term wouldn't feature in the variance for today. So if yesterday's return was positive, we wouldn't have this extra term in the variance, the last one there. We just have a normal GARCH11. If yesterday's return is negative, we get an extra term in addition to the GARCH11, and it increases volatility because of the negative return yesterday. And the size of the increased volatility is going to depend on the size of the negative return yesterday as well, because it basically depends on u of t minus 1 squared. Okay, so if you were testing for a leverage effect, which you can do in your own data, you would fit this model, and you would check to see, is this gamma term here significant, and is it greater than 0? Okay, so when you run your GARCH11 model, you could also run a GJOR. When you pick the best one, let's say you find a GARCH11 is the best one, or a GARCH22, you can then run the same parameters. If it's 2,2, you can run a GARCH22 with this GJOR in it, add it in, and then you could check, is the gamma significant? Is it positive? And do you get a better information criterion score for that model than the other one? So we're going to cover that in the labs. So does everybody understand that? How the leverage effect kicks in, and it adds an extra variance to the model. Okay. So here's an example of a GJOR model. So this is similar to what we've been doing, but they're using monthly S&P 500 returns. So you can probably get this data from the book website. You know, all of the examples that are given in the Brooks book, the accompanying data is downloadable, and the code from Brooks's website. So in this case, there's a very simple model. You know, we're running y of t here is the S&P 500 returns. We were running y of t is equal to an intercept plus the Fama French factors. Here he just has an intercept term. He's got no other model in this. So you've got an intercept plus a residual in the model. And this is the equation for the variance of the residual. And it's that GJOR model that we saw based on a GARCH11. Okay, so under here, we've got the test statistics for each of these parameters. So what you find is that the parameter on the arch term here has got a small test statistic, so it's not actually significant. So this looks like it isn't actually a GARCH11, you would remove it. But then when you look at the leverage term, it's strongly significant. Okay, so the reason that this one isn't significant anymore, if you ran just a normal GARCH11, it probably would be significant. Okay, but because you ran a GJOR, it's actually saying that the arch term only takes effect when there's a negative return, and it's actually not significant otherwise. Okay. So it all seems to be happening when there's a negative return. Okay, and the autoregressive component on the volatility or the variance is highly significant. So if you wanted to calculate the variance of your residuals today, about half of the variance yesterday you would add in about half of the variance yesterday to predict the variance today. Okay, so about 50% of yesterday's variance is predicting today's, or in this case he's using monthly data, so 50% of last month's variance would go into the model for this month's variance. Then there's a constant term here, which sort of means if you look at plots of variance, they change over time. You know, but variance is always, if you look at it annualized for an indices or an index, you know, it'll be in the low teens, 10 to 13% would be very, very low. If you went back to sort of the 90s or something, and then it peaks over time. But the intercept is basically saying that there's a level that you start from. Okay, so that's the first term there. Then the variance of the previous day is predicting the next day. So you take half of the variance the previous day, you add it onto that level, and then you've got a term that depends on this indicator function for whether or not you had a negative return yesterday. And it's saying basically, if you have a negative return, you would add 60% of the negative return squared into your variance calculation. So that's a Garch GJR. So one of the applications of this type of thing is basically if you get a shock. So when we look at the residuals in our model, theoretically, you know, we see these U of t that we calculate, but theoretically that's random noise. That's outside of your model. So you've got a dependent variable like an index return, and there's some random noise that you can't predict that's affecting that. And one source of this type of random noise could be news. Okay, so when some kind of news announcement is made, there's a shock, and it can cause a sudden jump in a return for an index, or, for example, the outcome of an election. If there was a surprise, you know, when they're counting votes, sometimes there could be a swing, and there's an unexpected candidate wins. Or if you look at the recent election in the UK, where the Conservatives won, and you know Labour were the favourites to win the election beforehand, that type of thing is a shock, and that would often affect financial prices. It has big impact on different things. So, for example, you know, Labour will have different policies to the Conservatives that would affect companies and individuals. Labour were going to get rid of non-domicile tax status, for example, but the Conservatives didn't. So there's various news announcements that can have a very large effect. So theoretically, that's what we're modelling here. The shocks and the size of those shocks are what the variance determines. Okay, so yeah, if you look at the GJR versus the Garch model, this is the value of a lagged shock. So let's say this is minus, you know, it's going from 0 to -1. But let's say this was returns, and let's say there was some news announcement and they caused a 50% drop in the returns of some company, for example. This is basically working out the next day after the announcement what kind of an impact there will be due to the persistence of that shock. Okay. So for a Garch GJR model, there's a bigger impact the following day. Okay, so there's bigger volatility predicted the following day after a shock, after a news announcement, for example. if the shock caused a negative return, so let's say the announcement caused a negative return in the stock market index, the GJR model will predict a larger amount of volatility for the following day after that announcement than a standard Garch model. The standard Garch model is symmetrical. Okay, so positive and negative returns or positive and negative shocks, they both affect the variance the following day in the same way. But with the GJR, you see positive shocks, they don't really have as big an effect, okay, on volatility the next day. So does everybody understand the difference between the two and what exactly the residuals and the variance of the residuals, what they mean? The idea is this random noise that affects, financial returns. One of the sources of that is just news that you can't predict, and that's defined as a shock. It's a shock to your model. It's not in your model that predicts returns, and the persistence of those shocks, or the effect of those shocks on volatility, the following time period or lag time period depends on the type of model you use. Okay, so the Garch and the mean is a very simple Garch model. Basically, you can see here that you've got a Garch 1-1 for your variance, but then for the variable you're trying to explain, you've included the lagged volatility here in the actual return equation. So you're trying to forecast returns and you're saying the actual return depends on the previous volatility, the previous period's volatility. So there's a theoretical justification for that because investors, they demand return for a given amount of risk. Okay, so if you look at financial pricing and asset pricing theory, the amount of return you get is determined by the amount of risk you take on. People who invest in riskier investments, they expect a higher return. If the risk goes up, the expected return goes up. Okay, so if the volatility of an investment goes up, people will demand a higher return to hold that investment. It's riskier. Now, let's say you're invested in a particular company like Microsoft, and the volatility of their stock price suddenly increases. Okay, if their expected earnings stays the same or gets worse, the stock price, the current value of those expected earnings is the same as it was yesterday. Okay? So how are you going to get an increased expected return? Investors are demanding an increased expected return for holding a higher level of risk. If the risk goes up and the earnings don't go up, the only way for the expected return to go up and for people to hold the stock is for the price of the stock to drop. Okay? So if the price drops, then from that point on, if people buy it down here, for the same level of earnings or whatever, they're going to get a higher return. So when risk goes up, the price drops to give people a higher return in the future who hold that stock, to encourage them to hold it when the risk has gone up. Okay, so there's a relationship between volatility, the increase in risk happened first, and then the price dropped. So it caused an immediate negative return. And then from that point on, the return is going to be higher to compensate investors for the increased risk. So that's why volatility can appear in the return equation. There's a relationship between risk and return. And volatility is often used as a measure of risk. So the Garch and the mean basically just has a lagged version of the volatility in the expected return equation. Okay, So the other thing to remember is that it's possible to combine some or all of these models together. So when you ran your regression, you could have a lot of different factors in your linear regression. Then you could include ARMA terms. So, you know, you could have lagged versions of the index you're trying to explain. Then you can have MA terms on the shop. And then the variance can have all of these different variance models that we've discussed, like the Garch GJR. And also, your original equation could include a lagged volatility term to explain the return. So you could build up a very big set of models based on all of this. And how would you then pick the best model? Well, what we're going to do in the labs is to use information criteria. So when you've got your model, you're going to pick the best information criteria, the model with the biggest information criteria. Okay. So what use are Garch-type models? So modeling the variance also gives you models and forecasts for the original variable. And if you look at variance forecasts, you can come up with a variance forecast from a Garch model that covers a longer period. So let's say you're looking at monthly returns or whatever. You can roll forward a Garch model for a year. So you could fit a Garch model based on monthly returns, and then you could do a 1 month ahead forecast using that, or you could do a 2 month ahead forecast, or you could do a 12 month ahead forecast. It would probably work better for shorter periods, you know, consistent with what you originally fitted to. But because variance just adds over time, the variance over 1 month is the sum of the variance over each of 4 weeks. Okay? The standard deviation is the square root of the variance, and that scales with the square root of time. So if somebody gave you a standard deviation figure for 1 month, and you had to annualize it, you'd multiply it by the square root of the time, and the time would be 12, because you'd have 12 months in a year. So you multiply your monthly version by the square root of 12. To get the variance, you just multiply it by 12. Okay, so I mentioned that we can forecast variances using the Garch model. So we can plug in where you see all of these values, you know, if you've got y of t is a constant plus u of t, and you've got these sigma squared t is equal to alpha 0 plus u of t minus 1. You've got these t minus 1 values, so you can plug them in, and you've got your parameters. And that will give you your sigma squared of t. So you can basically roll forward. You can do that, that will give you sigma t, and then you can calculate sigma t plus 1 or sigma t plus 2. So you just plug the numbers in, and basically, period by period, you get a forecast for the next period. Okay. So what use are volatility forecasts? One of them is option pricing, as I mentioned before. The single biggest or most important input into an option pricer is the volatility. So if you have got a better estimate of volatility over the lifetime of an option than the person selling that option, you know, their price may be wrong. If you can consistently come up with better volatility estimates than the option market, you can make money on that. Because if the option market volatility is too high, then what you would do is you'd sell options, and you'd make money over time statistically, because they're overpriced. And if they're underpriced, the options are underpriced. So if the market's view of volatility is too low, and your model says it's higher, you will buy options and try and make money out of them that way. Okay, so there's different option strategies for trading volatility. So yeah, the other one there is conditional betas. So A beta is measuring how much a stock is going to move with the market. And if you can forecast the sigma squared of the market, you can forecast the beta of a stock in the future, which is just a component of forecasting the return of that stock. Okay. So dynamic hedge ratios as well. When you're hedging assets, basically you're trying to handle volatility. As the asset price changes, you're either buying or selling it, and the proportion of the futures position that you trade in to hedge an underlying position you have depends on volatility. Okay, so you calculate these dynamic hedge ratios, and those are based on your estimate of what the volatility is going to be. And a better estimate of volatility will improve that dynamic hedging. Okay, so I'm going to leave that there for today. There's just some examples here which I'll go through the next day, okay, from the book. And we're going to have the lab now in 20 minutes.